As you can probably tell from looking behind me, I'm obviously a huge Oilers fan, and since they're having such a sweet season, I figured I'd like ultra represent them today because they're so awesome. Uh, Actually, it's very sad. I don't want to talk about it. But today I'm going to talk about the difference between RSPs and TFSAs and just the difference. I'm not going to talk about which one is better because sometimes using an RSP is going to work out to your advantage and sometimes using a TFSA is going to work better. But I will say one thing, I really can't think of any case where somebody shouldn't be using a tax-free savings account. So one of the more confusing things people say is, oh, you can't make money in an RSP or a TFSA, but that's not true at all. You can actually invest in a whole bunch of different things inside of an RSP or a TFSA, and they have similar rules for this. So I'm just going to go through a list of what you can and can't own inside of those accounts. And I want you to start thinking about an RSP and a TFSA as like they're just bank accounts or whatever, right? They're like a checking and a savings account, but they have different rules than checking and savings accounts because they have more specific purposes. And that's all they are, is they're a place to put money in and a place to take money out, and they just have rules to them. So when you put money in these, this is what you could buy. You could just keep your money in cash or a high interest savings account. You could buy GICs. You could buy bonds. You could buy any kind of mutual fund. You can buy and sell stocks. You can buy and sell ETFs. You can buy and sell mortgage-backed securities. You can buy and hold Canadian mortgages inside those. Income trusts like real estate investment trusts. And gold and silver bars. I wasn't actually aware of this. I think you would have to go to the bank and say, I want to put like a gold bar that I own into my RSP, and they would hold it for you. That's my guess. Things you can't own in your RSP and TFSA, any other precious metals or just like limited amounts of gold and silver, personal property like art, cars, jewelry, stuff like that. Physical real estate, you can't put your house or like a building inside of your RSP or TFSAs. Shares in a private company, so if you bought like a portion of a restaurant, you can't put it in there. And commodities, futures, contracts. So if anybody ever tells you it's impossible to make money inside of an RSP or a TFSA, that's there couldn't be anything further from the truth. You could have bought $10,000 worth of Apple stock in your RSP in 1975. I'm pretty sure that would have made pretty good, damn good money. And it actually makes way more money than if you don't invest in there. And that's where the confusion is. And so today I'm just going to talk about tax deferral and tax free, which is what the tax free savings account is, and give an example. So basically all you need to know before I get started on this is that if you put money in your RSP or your TFSA and own the exact same investments, they are going to grow at the exact same rate. They're not taxed while they grow. But if you're not holding money inside of one of those accounts, it's going to be taxed on the growth every single year, and then you're going to have less invested going forward, so the compound growth is actually smaller. So those are the similarities, which are easy to understand, and now are the differences, the first difference is the contribution limits. So for an RSP, you get 18% of your income every single year that builds up in RSP room. So if you made $100,000, you would get $18,000 in RSP room that year. If you don't use it, it carries forward. However, the government actually puts a limit on this. So their number is about 146,000, so the RSP limit is 26,230. So if you make over 146,000, your RSP doesn't grow any further than that. It's just kind of like, so rich people, I guess, can't put too much money, save too much in tax on that. And another thing is, if you have a pension at work, then what you'll see is you'll get like a pension adjustment formula that will reduce your RSP room based on a specific formula. Because all an RSP is trying to create a pension income for people that do not have pensions. That's all an RSP is. It isn't really anything else. So if you think about it like that, then it starts to make sense. Now the TFSA doesn't care how much money you make. It just cares basically what year it is and how old you are. So every year on January 1st, your tax-free savings account room goes up. This year the limit went up by $6,000. So if you were over 18 in 2009, you would now currently have $63,500 in tax-free savings account room. Pretty simple, just goes up every year on January 1st. And now I'm going to give an example, a comparison of how they would work next to each other. And I'm just going to look at a 30-year-old husband and wife. They both make $60,000 and they both want to invest $5,000 every single year. But the wife doesn't like RSPs. She just wants to put $5,000 into her tax-free savings account every year. And the husband wants to put all that money in his RSP because he heard that RSPs are great and that's what he should do. So the husband makes $60,000, and over the course of the year, he has paid money or taxes on that income off of his paychecks like he made $60,000. So when he puts in that $5,000 chunk at the end of the year or over the course of the year, what it does is it says, we're going to reduce your taxable income by that amount. So 60,000 minus 5,000 equals 55,000. Now he's paid tax on that last $5,000, so that's where the tax return comes in. In my case, he's in a 30.5% tax bracket, so he's going to get back $1,525 a year. So now they've both invested with the same person at the exact same time, in the exact same funds, in the exact same portfolio, and they got 5% each on their returns. So now they have both invested $175,000 until they're 65 years old, and they both have $451,000 in their accounts. The husband has $451,000 in his RSP. She has $451,000 in her tax-free savings account. They've made $276,000 over that course of time. Now, the only difference so far is that the husband got back $1,525 every year, which would total $53,375 in saved taxes over that period. So he had more money to spend on whatever. And now we're getting into the big difference and why human beings hate RSPs is because they don't see it as a pension thing. They'll see like their dad has an RSP worth $500,000 or something, and he passes away and they think they're going to get a big inheritance. But that means that they all of a sudden sell that RSP on the day that he passes away, and he has to pay tax on $500,000 worth of income in 1 year. He's going to get hammered by the tax man. Your inheritance is going to be half of what you thought it was going to be. Because it's supposed to be a pension, it's not supposed to be for, your beneficiaries or setting up a big estate. There are other ways to do that. So now we're going to look at withdrawing this amount from 65 years old to 90. So he can pull out $26,000 a year out of his RSP, and she can pull $26,000 out of her tax-free savings account to make that last until 90 years old if they're still getting that 5% rate of return. We're also going to assume that they're both getting an income of $20,000 from CPP and old age security, so $46,000 each before the tax man comes. But his full $26,000 withdrawal is taxed, plus his CPP and OAS income, so his average tax rate is 17.04%. So his RSP withdrawal is taxed $4,430 a year, and after tax he has $38,163. I know 46 minus 4430 doesn't add up. That's because the CPP and OAS were taxed at that 17% as well. His girlfriend withdrawals, or his wife, withdrawals the same amount, but she's only taxed on her CPP and OAS income because everything she pulls out of her tax-free savings account is completely tax-free. So her average tax rate in retirement is only 6.69%, which is absolutely amazing. She's left with $44,663 after tax. I mean, she's only losing $1,337 or whatever that is. So she actually has an extra $6,500 a year that he doesn't. So that appears to be the clear winner. But is it? Maybe it isn't, because what about that $53,375 that he got back over the course of his life? Well, what if he took that $1,525 tax return every single year and didn't blow it on stuff and actually put that into his tax-free savings account? Now he has $138,000 in his TFSA, $451 in his RSP, and when he pulls it out, he's actually left with $46,088 per year, which is now $1,425 after tax higher than his wife. So that's why I always say they're a perfect complement for each other. It doesn't make sense in every case, and I'm not saying that. There's a lot to RSPs. TFSAs are a little less complex, but they are good for most Canadians. It's a good part of an overall financial plan. TFSAs are amazing. Can't say enough good things about them. Thank you very much for watching this whole video. I know it was long, hard to look at the Oilers stuff, especially if you're a fan. But thank you again. Please subscribe, and we'll see you next week.